All right, we finally got through objective 3.4, which was awesome, very important stuff. Now we're going to do some mopping up, and there are these things called closing entries. Um, what are we closing? Well, temporary accounts. They're closed each period to prepare for the next reporting period. It's kind of like your trip odometer on your car. If you want to know how many miles you're going from one place to the next, the easiest way to do it is to reset it at zero. And that's what we do with these temporary accounts. What accounts are the temporary accounts? Revenues, expenses, and dividends. The other accounts are permanent accounts, and they always carry a balance, like your cash account, your own personal checking account. If it hits zero, it's not because you did a closing entry, but it typically carries a balance. It carries a balance always, and we don't create an entry just to reset it back to zero. And the reason we're closing these revenue expenses accounts and dividend accounts, these are flow measures. They're measures of activity during a certain period of time. So we want to reset it at zero so we can compare month to month, quarter to quarter, and year to year. Okay, so what is a closing entry? It's just a journal entry that results in a zero balance for a temporary account. So, and you're doing the entry for that purpose. Okay, so here's an example. Dividends at the end of the year had a 4,000 debit balance. We're going to need to put in a 4,000 credit balance to close it. And this is a closing to retain earnings. So after the fact, you have retained earnings started like this. Here's your posting. Wait, shoot. Sorry, wrong account. Yeah, it's not liking that eraser. Let me try this eraser. Okay, thank you. Thank you for letting me use that eraser. That's good. All right, this is the dividend account. All right, and this is the posting to the dividend account, which results in a zero balance. So dividends have a normal debit balance. After we do the closing entry, it's back to zero, so we can go for next year, see how many dividends we have next year. Okay. Now, I will say dividends are being closed to retain earnings, and that's not weird at all, right? Because we have the statement of retained earnings, and this dividend, this posting here will reduce retained earnings. But you can also close expenses and revenues to retain earnings. However, sometimes what's done is, let's say you have revenue is a credit balance. They'll close to an account called income summary to keep track of all your income. And then you'll take income summary and total expenses, XX, YY, and then you'll close income summary hopefully revenues greater than expenses, income summary to retain earnings. Okay, so this would be like closing net income to retain earnings. Okay. In your textbook, they give you an example where they close it all to retain earnings, that's okay. It's okay to do that. But I want you to know that there's this other account called income summary, and it's typical for it to be closed income summary, and then income summary closed to retain earnings. All right, but this isn't really going to affect income. We've already calculated it. It's just preparing the books for the next cycle. All right, and finally, let's just squeeze objective 3.6 in here. We're going to evaluate this the debt paying ability of this company. And excuse me, that was on silent. I don't know what happened. All right, so the first number we have is net working capital, and that's just total current assets less total current liabilities. Having more current assets is good, so a positive number is good, negative is bad. The larger the positive number, the better. Okay? The current ratio, another great liquidity measure or measure of ability to pay. Total current assets over total current liabilities. You definitely want to have a ratio of 1 or more. And anything below that is very weak. But the rule of thumb is over 1.5 you're okay, and over 2 is very strong. With this ratio, larger is better. The debt ratio, total liabilities over total assets, so this is just a rough measure of your total debt. Lower is better, so less debt is less risky, but it definitely varies by industry because, like in banking, they have leverage ratios or debt ratios of 90%. Most every other industry would go bankrupt if they were that high. When you're not given info in our class, assume that anything lower than 60% is pretty good, it's moderate risk, and below 40% is low risk. Okay? And at this point, when we go over these ratios at the end of the chapters, you want to know how to calculate them and how just to interpret which direction or which level the number is better. Okay? It won't be till the very end of the term when we go into financial analysis. We might dig a little deeper.